I've seen a lot of news lately about Forex prop firms having issues, and this is driving some traders to move from Forex to futures trading. Since I have made this transition in my own trading career, I believe I am qualified to give a brief overview of what you need to know when moving between Forex and futures. But first things first, the Forex that you all know is actually not Forex at all. It is CFD, or contracts for difference. Now that we have that out of the way, I'll be referring to Forex as CFD from now on. Essentially, CFD and futures are almost identical, as both are derivatives of the underlying asset. If the asset went up in price, CFD and futures will follow suit. Futures are standardized contracts that enable traders to buy or sell a specific asset at a predetermined price and date in the future. Now that we have covered the basics, what are the differences? Well, in terms of ease of access to different instruments, with CFD you can trade a variety of instruments, including many exotic forex pairs and other countries' stock indices. However, with futures, you have to trade with each country's specific exchange. If you're trading with a US prop firm, keep in mind that much of futures trading in the prop firm industry is US centric. The instruments you can trade are usually related to the US financial markets or the US dollars. If you want more exotic futures, you have to use your own personal capital and go to different foreign exchanges. In CFD trading, a Nasdaq 100 is a Nasdaq 100. If you want to position yourself larger, you just need to increase your lot sizes. In futures, we also buy more or less contracts, but there are also separation into base, minis, and micros. We use the term minis and micros because that's what they refer to, a mini version of the original futures contract and a micro version, which is even smaller. Usually these are 10 times smaller than the previous version, but this also depends on the type of futures instrument. Personally, I find that you need to have more money to trade futures compared to CFD. In those discounted futures brokers, you can trade one micro ES contract for $40, one micro NQ contract for $100. If you go to ES or NQ, the minimum amount is 10 times that of the micros. So it is $400 or $1,000. This is why with futures prop firm, you cannot hold position in between regular trading hours and the Globex open. The actual maintenance margin currently required to hold a trade overnight is $12,000 for an ES contract and $18,000 for an NQ contract. You being able to trade on day trading margin is because the discount brokerage is lending you their money to day trade. The futures prop firm is following the same principle. They don't really have the capital to hold the trade after close per exchange rule. Full-fledged broker like Interactive Broker apply the maintenance margin straight away if you want to open a futures position. They don't have any day trading margins shenanigans. Thus, trading with CFD require less money to start because everything depends on the liquidity provider. Fun fact, the original S&P futures contract was discontinued a long time ago because its size was just too large for all but those with very high capital. Remember, a S&P futures contract represents a fraction of the S&P 500 market, and the size of the US financial market is not small. When the E-mini was introduced, even large banks preferred it because it was easier to control their position size. When it comes to price, the price of futures is determined by the buying and selling on the exchange, while the price of CFD is often determined by the brokerage. It is for this reason that I actually made the move to futures in the first place, because for me, the futures price is more of a gentleman's price, as it is derived from actual buying and selling, and I can be very precise in the price I entered. In contrast, For CFD, have you ever noticed how your CFD charts might look a little different for the same instrument depending on the broker? The brokerage often determines it by the liquidity in the liquidity provider at the time. So, in cases like when there's a sudden spike, the futures exchange will record the buying and selling properly. But the CFD might record different prices depending on the brokerages, as liquidity might dry out. Sometimes, especially in high impact news, you can see that for the same instruments, the charts can be different for the same underlying. For example, in futures, you can have a lower low, but in CFD, you can record a higher low, and that is giving you a false knowledge of the market. In CFD, the position and the value of the positions are measured in pips and lots, and in futures, it's ticks and contracts. These are all essentially the same. For example, if you look at the E-mini S&P 500 for one contract size, one point of the E-mini S&P 500 is $50 in value, but each point is separated into 4 ticks. That's why each tick has a value of $12.5. So, how do we count our position size? Let's say I enter an ES long at $100. My stop loss is at $90 and I am risking $1,000 per trade. From 100 to 90, that's a 10 points stop loss or 40 ticks. It's a 50 times 10 equals $500. And since I am risking $1,000 per trade, it means I can trade 2 ES contracts. There is minimal to no spread in the futures market, whereas you have the spread in the CFD. While the CFDs can run forever, futures contracts have a set date to settle. Think of it like a rental agreement for the underlying asset. Once the contract expires, you either gotta buy or sell the real thing, or roll over your position to a new contract. No pressure though. Most futures day traders are in and out before the market closes each day. In futures, you have continuous and front month contract, which is when the futures contracts are usually measured. Like let's say for the financial months, you have H, M, U, and Z. This refers to March, June, September, and December. An example is the current ES contract I am trading, which is ESH 2024. What it means is an ES contract expiring in March 2024. Right now, in March, I am currently trading on H contract, but I will need to move to contract M because the contract H will expire soon. And that means no one is trading the contracts anymore, as they have to deliver on the underlying asset, as each futures contract has an expiry. Some futures contract goes by month, some by quarters. How do we know when we change this future contract? Usually it is when the volume of the next cycle contract is larger than the current cycle contract. You will be able to know this because many trading platforms like NinjaTrader or TradingView will recommend you to switch the contract instruments on the platform. When it comes to the platform, you might think that MT4, MT5, and CTrader are usually for CFDs, whereas NinjaTrader, Quantower, and the like are for futures. But actually, this is all dependent on the brokers, because the platform you have is just instruments to facilitate trading, record the price, gather the price for the chart, and also execution buying and selling. All the platforms I mentioned earlier can actually trade both CFDs and futures. It just depends on whether the broker allows it or not. As for getting market data, you can get the CFD data for free from the broker. But for futures, it is an exchange data. So you will need to pay a data fee to get the data price from the exchange. If you are just using purely from TradingView, you can pay TradingView a subscription fee for the data. But you can also use the prop firm data, which they usually provide via TraderVet or the Redmic demo account. I have my own capital trading account via MP Futures. I also pay for data there, but I think it's cheaper by a buck or two compared to buying the data fee from TradingView. So, is there any reason why some might stick to CFD rather than futures? You might not know this, but for folks in the UK, there's a thing called spread betting, which is essentially like CFD, only because you are betting on the result of the price movement instead of owning asset. Spread betting is actually 0% tax. I actually recorded this video about 3 weeks prior, but my files got corrupted and I ran out of time to do it. So I hope you enjoy and like this video, though I wanted to get this out earlier. If you have any questions, do let me know in the comments so that I can answer on them.